Hey, good morning, everyone. Marty Missouri here, Wednesday, the 21st of December, 2021, with a stock market snapshot, the midweek snapshot. Also, clients, this will be the morning note, or I should say, this will be in lieu of the morning note. As I said on Monday, or as I wrote on Monday, the blog post will be a little sparse next couple of weeks as I focus my writing time on what is generally or typically a pretty lengthy year-end, kind of deep in the weeds letter to clients. So that morning note time, I'm needing to gather my thoughts and focus on what is most important in our view going forward into 2023, what we're going to be thinking about, what we're going to be hedging against, and then our long-term structural view on things like inflation and how that impacts commodities and the price of commodities, equities, fixed income, and so forth. So for this morning, I'll keep it quick. So here's your one-year daily chart, and recall a couple of things that I've been talking about the last several weeks as potential downside targets. One was the filling of this gap right here on the November CPI print, right, where the market loved the softness of it and it just shot right up there. On the daily chart, I have to distinguish because I'll show you the hourly chart here in a second, but on the daily chart, we did fill the gap, right, and made a real strong case, I thought, for 3,800 being really strong support if and when the market gets down to that level. And that seems to be playing out. A couple days ago, you can see we hit it. We bounced right off of it. We're bouncing off again as I speak right now. The S&P is actually up over 1%. So maybe we are going to get that Santa Claus rally this week. We'll see. Also recall that I mentioned in yesterday's written note that the setup coming out of the close on Monday on the very short-term basis, and I'll show that on the hourly chart, actually looked short-term constructive to me. So it didn't surprise me when futures were doing well overnight, but then they staged a sharp reversal on the news from the Japanese central bank that they widened their range, target range, or their yield curve control range, impacting the 10-year government bond in Japan from 0.25% max range to a 0.5% max range. I won't get into those weeds because I did that a bit yesterday on the written blog. And I also said, though, that the technicals were telling a little bit different story. It looks like yesterday, although it wasn't a big monster up day, although it was a nice comeback from where futures ultimately were. Turned out to be what to focus on, I think. And that's the case today, particularly when we look at the hourly chart. So other than the bouncing off the 3,800 on the daily chart, it's not looking all that great in my view. So when you bring in the MACD and the RSI, as we always do, as you can see, a little bit of hope here as we begin to turn up. And of course, I could get bullish, but not a real constructive, in my view, looking daily chart still, right? We had that double top right there, but we were rolling over, and we had those bearish divergences. So we're going to have to see a lot more here on the daily before this starts looking anything like a bullish setup. Now we may get that, or at least we can see hope for that, I guess, for the bulls when we look at the hourly chart. So this is where it was coming from in Tuesday's written note, is that we were staging one of my favorite patterns, and that is on the bull side where you have a falling wedge pattern and you have these bullish divergences here on the momentum indicators. And sure enough, that's what's playing out right here. We're getting a bounce out of that. Still looks good on the hourly chart. That's what I mean when I say that we could get enough upside over the next few days to make the daily chart look a little more short-term bullish. Longer term, though, we still have this bearish divergence here that needs to work its way out to the upside if we're going to enter into a new bull market again. Keep in mind, this is just the hourly chart. When I talked about filling that gap on the daily, on the hourly, we really haven't just yet. So you can see if we just screamed up, and that takes us all the way down here to 37.37. I'll be surprised if we get that before the end of the year. But I'll also be surprised if we don't do that, and more frankly, sometime first half of next year. And that's my fundamental view based on our economic assessment going into next year, which I've spent a lot of time on. Technically, let's go a little longer term and take a look at the weekly chart. So recall again, as I keep repeating on these videos, that back in the day, earlier this year, as this bear market was taking shape, we drew a line in the sand of 3,500. Let me expand that here. Of 3,500. And sure enough, on a Thursday, hit it and bounced off of it intraday and haven't seen it since. I'd love to say, and stick to that original target, that that's all she wrote. I even said back when we forecast that sometime earlier that we would be backing up the truck and getting more aggressive. But I added the caveat that if we are in recession, one of these big shaded red areas, then we're likely going to go lower. Argument there is that this is a corrective phase, let's say based on rising rates and stocks appropriately declining in value relative to rising rates. But earnings ultimately holding up because we're not in a recession. We weren't back here, or we weren't seeing one coming. And so looking at 30 years of history, both on the monthly and on the weekly charts, we drew the conclusion that 3,500 looks like the right spot. That caveat, though, is why we now think it probably goes lower, because we do see the likelihood or probabilities pointing to a recession next year. We think it'll be a mild recession. We don't think there's some big, say, credit market explosion that could possibly happen like in 2008 or like we expected from junk bonds in early 20. But just kind of your garden variety recession, inflation heating up, Fed tightening, over tightening, recession, the conclusion, Fed easing, come out of the recession, and then we're off to the races again. And the bear market is done for good. We think that's the likely scenario playing out the second half of the year. So what does that mean in terms of going down below? This gets a little harder because we just don't know, ultimately how bad earnings are going to be and yada yada if we do have a recession. But if we just do it kind of simply and we look at past support areas and resistance areas over the last 3-4 years, and then we consider the Fibonacci retracements, you see 61.8 right here, general price patterns and so forth, we think around 3,200 would make some sense as a garden variety bear market in a garden variety recession, which would be about 33% lower from the top. I'll call it 15% from where we are now. Could you get to 3,000? You could. 3,000 is right in here, and you can see there's some action on the weekly chart right back here as well. So if you break through that, we think that's the next legitimate target. And we can talk about other levels if and when we get there. But below the 3,500, if you break this with momentum, which we think odds favor next year, well, then there's really just not a lot going on in terms of support, at least technically speaking, between 3,500 and 3,200. But anyway, for what it's worth, just areas to keep in mind as we get there. If we do, of course, we're going to be looking for other, call them fundamental macro trends to be improving that give us confidence right in here as well. Beyond this bear market playing out, we have a thesis that says the next bull market is going to look very different than the last. We anticipate that non-U.S. securities will probably reign over U.S. securities. We think that commodities make a tremendous amount of sense. We think the dollar is going to trend lower during the next bull market as opposed to higher like the last. And we think the world's changed fundamentally. We think that we are entering a new and very long labor-friendly regime, and the political zeitgeist will be taking care of the rank and file, which is perfectly fine, back to labor-intensive policy. Unions seem to be breathing some life once again. I haven't seen an updated statistic, but at one point over the last few months, we had 100 more major strikes this year than we did last year. So a lot that goes with populism in a labor-friendly regime. One of them very distinctly is protectionism, right? Take care of ourselves, deglobalization, bring it home to the extent we can, and so forth. That is a inflationary environment, certainly when you consider or compare it to the producer-friendly or the capital-friendly regime that we lived pretty much from Ronald Reagan and Margaret Thatcher's elections up until recently. It's very clear. The reaction to COVID, China's reaction to the recent riots around zero COVID, France and Germany's reaction to higher energy prices in terms of essentially, call it support. Some people would call it giveaways, free money, what have you, to the population. This is structural, decades-long phenomena. The capital-friendly regime tends to end with huge wealth and income inequality. It's at an all-time record here, folks. And like I keep saying, the labor-friendly regime comes with higher inflation over the long run. And I'll leave it there. Hope you have a great day. Talk to you later. Bye-bye.